Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Chris Englebert. He's the founding partner and chief investment officer at Englebert Financial Advisors. With our monthly RIA strategy update, we're going to take a look at setting return expectations for 2020. It's great to have you back with us as always, Chris. And great way to start out the year. January certainly has given us plenty of news to talk about, but I want to take a look at our first chart that we have here and setting those return expectations for 2020.
Yeah, Jill, one of the things that happens with investors is many times we've had a great year. 2019 was exactly 180 degrees opposite of what happened in 2018. And so what we're trying to have people understand is they really need to focus on the sequence of returns that they're getting, because they see a big number like last year and they say, oh, gee, the party's over, the top is in, 2020 is not going to be that good year. And we show some statistics here that last time we had a big year in 2013 of over 29%. It was followed by a good year in 2014 of 1139, but not so good of a year in 2015. But then you can see going back to 2003, we had another big year followed by a decent year and a smaller year. So the bottom line that we're really trying to tell people is that we had a great year in 2019. 2020 could still be a good year, but they've got to understand you're not going to have exactly the same sequence of returns.
Well, the thing, you have this whole FOMO mentality, but if you look at 2004 with 8.9% return, I'll take that. That's not a bad return at all.
No question about it. And so, again, we get people going, wow, the market can't go any higher. There's a top that's been put in. But they also have to understand, we've had several months. Obviously, the fourth quarter was straight up. The January, if we had gotten out of January in the last week, it would have been an up month, but it was a down month. But we think what's going to happen in 2020 is there's going to be a lot more volatility, a lot more news-driven headlines out there. And so, again, the sequence of returns are going to become much more important for investors in 2020.
All right, now here's an interesting question I have for you, and it goes to our next slide here. Should RIAs be hedging their book?
Yeah, this kind of drives me crazy because I come from the Midwest and an agricultural background. And if you're a farmer with 1,000 acres of corn or 1,000 acres of soybeans, you plant in the spring, you reap in the fall, but you always are laying off your risk somehow. And I can't tell you the number of RIAs that I've talked to about this particular topic. And I say, okay, if your business is really obviously, fee driven, and you have a 20% drop in the stock market, the fees or revenue for your firm are going to drop 20%. You're going to end up laying off people. You're going to end up cutting back on marketing. Everything that you shouldn't be doing, you end up doing. So why aren't you treating your business like truly a business, like a farmer, and looking at different ways to hedge your book? Now, again, the previous slide, we talked about how 2019 was a great year. 2020 is going to have some more volatility. But again, if we have a 10 or a 15% decline in the markets, your fee revenue for that quarter may end up declining.
Right. Do you think it's a lack of knowledge with understanding how to use puts, how to use calls, how to use the indexes when it comes to hedging? And in all honesty, there's so many ETF products out there now that have the built-in hedges and the built-in strategies. Is it lack of advisor education, and they just need the training and the tools to do so?
I think you're exactly right. I talk to a lot of RIAs who may be very good at investing their clients' money, but there's good at investing a client's money, and then there's good at running your business. And many of them don't sit back. They're too busy working in their business rather than working on their business to step back and say, hey, listen, we have $250 million in assets. Our fee revenue per year is $1.8 million. What would happen if the market went down 20%? What would happen to our shop, and how should we protect that? So I think it's a lot of education, and sometimes the old adage goes is even the cobbler's kids don't have good shoes.
I mean, even if you look at fourth quarter of 2018, relative to the rest of the market over the past 10 years, you have a generation of advisors out there who have not traded a high interest rate, a bear type of market, or significant volatility. Even last week, we were not anything historically out of the norm when it came to the VIX.
Yeah, and that's what I'm a little bit worried about is that, if we, and again, we're not saying that anything cataclysmic is going to happen, but obviously the coronavirus is in the news. And if that keeps rolling and really creates a situation where the markets actually retrace some type of significant amount, there's going to be a lot of shops that are sitting there going, wow, our fee revenue isn't where it should be. And they could easily mitigate some of the risk by taking advantage of some of the hedging strategies. There are so many tools out there right now to use. They've got to educate themselves and figure out out how to use that in their business.
All right, let's take a look at the charts where we go for price confirmation. Our first one here, we have the S&P 500.
Yeah, again, straight up, one of the things that we want to talk about is that this has been a big cap-led market. Obviously, the S&P 500 and the Nasdaq have really led it. I always like to talk about kind of an army situation where you have the generals and you have the soldiers. And, for example, the Russell 2000s are kind of the soldiers of the group. And, we're questioning whether or not the soldiers have kind of left the field. The generals have really led the charge the last couple of years. And literally, we're getting to be a narrower and narrower advance with fewer and fewer big stocks. In fact, if you look since last week, there's about 4 or 5 big cap names that have really been driving the market higher. Now, what we think is going to have to happen is that we're going to have to see a period of consolidation, maybe some broadening out. Again, we're not looking for a significant pullback, but you've literally had this charge, no pun intended, led by the generals in the market.
Yeah, right. And we'll see that in our next chart here. Of course, we have the Nasdaq 100. All those stocks that have been leading the charge are large cap Nasdaq 100 constituents.
Yes, and it's funny because I had a conversation just the other day with a value manager, and we are beginning to see the second coming of the historic gap between value and growth. And I remember this summer when we did our trade talks, value started to pop up and everybody's like, hey, it's the death of growth. And then growth just re-accelerated and we've went on to new highs. At some point, these dividend-paying stocks are going to look attractive, either because of the volatility that we see in the markets or because you've got investors looking for income, because we're going to get to that in a minute.
Yep, that was the big topic of conversation when we were down at Inside ETFs, looking for alternative forms of income because you're just not getting it in traditional bonds. So let's move along to our next chart here. Actually, we're going to take a look at crude first because this chart clearly can't get out of its own way.
Yeah, so one of our calls that we made about 6 months ago was that we really thought that with what was going on in the supply of crude and the fact that the global markets were beginning to accelerate and the global economy was beginning to accelerate, we have to say when we're wrong, we're wrong. We thought that crude would easily be over $70 a barrel by this spring. You can see that, again, fears of a global slowdown has gotten crude back to that $50 level. This is building in a big long-term kind of sideways trading pattern, which is actually a good base. And you can see where there's value. And obviously in the news, there's some talk about the OPEC nations and Russia, cutting crude productions. They need crude north of $60 a barrel to really help their economies. And you can see where it is right now. So we're still standing by our longer term higher price call, but it may now have been moved out to third or fourth quarter of 2020.
All right. Our last chart here, we're going to take a look at the 10-year Treasury. This goes back to, do we have the 10-year Treasury?
Yeah, 10-year Treasury. Yeah.
It's the wrong title, but this is a 10-year Treasury.
Yeah, 10-year Treasury. And so you saw, obviously this summer, we saw a big drop in rates. Our main thesis is that when people realized that the U.S. economy is not going into recession, that rates were going to float higher. Rates did float higher through the fall, November, December, but now you've seen again a rush to safety. The coronavirus has gotten bond people long. Rates have driven back down. But we put a line here to show that right around the 185, 190 level seems to be very important. And you can see that if we continue to work higher, we again believe that now the back half of the year, you could see higher interest rates for 2020.
All right, Chris, as always, thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.